is like enriched uranium. You need a crypto reactor to create credit. So for every dollar of equity capital, of Bitcoin capital, you can create about 10 to 20 cents worth of digital credit. So if you have $100 billion worth of Bitcoin capital, you could create $10 to $20 billion worth of credit per year. You would need a public company. It would need to be exclusively invested in Bitcoin. So if a bank wanted to do this, they would need to create some structure that has $50 to $100 billion worth of Bitcoin held in one entity, and then they would have to go do an IPO and take a digital credit product public. If they were to do that, we would welcome that, because that would mean that another big company is buying $100 billion of Bitcoin, and I think that would be good for everybody in the Bitcoin space. If that were to happen, our Bitcoin price would go through the roof. We would end up inheriting another $50 or $100 billion worth of Bitcoin on our balance sheet.
In a market driven by emotion, clarity is your only real asset. Subscribe to keep your thesis sharp and stay ahead of the macro shift.
You just heard Michael Saylor compare his product to enriched uranium. And he wasn't being dramatic. He was being precise. Because what Strategy has built with STRC is something the financial world genuinely has no category for. It's not a bond, it's not a stock, it's not a stable coin. And yet, it's doing something none of those things can do right now. It's paying retail investors 11% yield backed by Bitcoin with a fraction of the volatility. Let that sit for a second. Bitcoin has been returning an average of 39% per year over the last 5.5 years. Saylor just told us he expects 30% annualized returns over the next 20 years. And if you take just 1/3 of that appreciation, you can pay a credit instrument 11% and still leave a fat margin for equity holders. Nobody in traditional finance can do this. Real estate returns 6%, so asset-backed credit on real estate tops out at 3 or 4%. That's your mortgage-backed security. That's your REIT dividend. Gold is worse. The S&P 500 would work in theory, but the SEC Act of 1940 blocks any large public company from putting more than 40% of its treasury into securities. Strategy isn't a fund. It's a Bitcoin company, and that legal distinction is the entire ballgame. What Saylor is describing is a 3-layer monetary architecture. Layer 1, Bitcoin itself, 40 volatility, 40% ARR, pure capital. You hold it for a decade and you don't touch it. Layer 2, STRC, 2 volatility, 11% yield. You hold it for 12 weeks or 12 months when you need your money working but you can't afford to lose it. Layer 3, and this is the one that should make your ears perk up, a 0 volatility, 8% yielding instrument. A Bitcoin-backed stablecoin that pays you more than inflation every single year, denominated in dollars. That third layer doesn't fully exist yet, but STRC is the bridge to get there. And here's what most people completely miss about this. STRC is already inside BlackRock's credit index, PFF. It's the number 3 holding in VanEck's PGX credit index. Retirees are buying it. Crypto entrepreneurs are using it as the yield source for their stablecoin protocols. This isn't a niche product for Bitcoin maximalists. It's infiltrating the same institutions that manage trillions in retirement savings. Saylor was asked about competition, banks, money market funds. What if JP Morgan tried to copy this? His answer was essentially, good luck, and also we'd love that. Because to replicate what Strategy has done, a competitor would need to accumulate $50 to $100 billion worth of Bitcoin in a single entity, take it public, and then build out a digital credit product from scratch. And if they do that, they just bought $100 billion of Bitcoin, which means Bitcoin goes up, which means Strategy's balance sheet goes up, which means STRC gets more collateralized. The moat isn't the product, the moat is the scale, and they built it first. The better play for any bank, Saylor said, is to partner with Strategy, offer their customers 8% digital money accounts powered by STRC, keep 200 to 300 basis points, and collect $1 trillion of deposits with 0 risk. That's the offer on the table, starting tomorrow. Now let's hear directly from Saylor on how all of this actually works.
Stretch transforms a 40 vol, 40 ARR capital asset, Bitcoin, which is a commodity, into something that's more like a 2 volatility, 11% yielding, cash flowing credit instrument. So it's a gateway security. It takes the raw monetary energy of a commodity that's volatile and long duration without cash flows, and it makes it non-volatile, short duration with cash flows. And we think of it as like the layer two. Bitcoin is digital capital for capital investors. You could hold it for a decade. And if you have a decade and you have a low time preference, you don't need the money now, then you hold the capital. Stretch is a short duration credit instrument. So if you need the money back without the volatility over the next 12 weeks or 12 months or 12 days, then it's a stepping stone. And from Stretch, we see the possibility to create zero volatility, 8% yielding money. And so if you think about the mythical Bitcoin-backed stablecoin that pays you 8%, right? Well, Stretch is not quite that because it's got the 2 vol, but it's the intermediate step, and we see the exciting formation of a 3-layer monetary architecture: capital, that's 40 vol, 40 ARR, credit, which is 2 vol, 11% yielding, and then money, that's 0 vol, medium exchange, a unit account, a store of value. You can use it instead of a stable coin, instead of whatever. But as long as you're holding it, it's outperforming the monetary debasement rate or the inflation rate. And so all 3 of those would be assets that would be useful to the world in different contexts. And we think that will result in an overall growth of the Bitcoin ecosystem. We've had extraordinary success with retail investors.
Okay.
Retirees, any ordinary person that needs money to pay their mortgage, that needs to pay their taxes in 6 months, that needs to put their kids through college. They've got money sitting in a money market. They're afraid to invest it in the stock market because the stock market volatility is 15 or 20. Mm-hmm. They might be down 10% in 6 months when they need the money back, and that feels awful to lose 10% of your family's capital.
Yeah,
right?
Definitely.
So retail investors have been big buyers. Credit investors, Stretch has been incorporated into BlackRock's credit index, PFF, and into Van Eck's credit index, PGX. And it's like the number 3 holding in those credit indexes. Then you've got some equity investors, you've got traditional MSTR investors, and the other buyers now are crypto entrepreneurs, people that are developing savings coins and stable coin and yield protocols with stable coins. A lot of people want to generate yield on a stable coin, and then others want to generate yield on Bitcoin. And so STRC is a source of yield for either stable coins or Bitcoin. And of course, it works really well with stable coins because it's pegged to the dollar. And so if we've got something which is targeted at $100 and you're creating an asset which is targeted to trade at $1, then we've taken the 40 vol down to 2. So we've already taken 95, 96% of the volatility off the instrument. And then that leaves the entrepreneur or the people that are creating these digital money funds and digital money tokens and things. It leaves them to take that last step. Digital credit is asset-backed credit. So I sell a credit instrument and I invest the proceeds in a capital investment that I hold for the long term. The capital investors hold the investment for a decade, and the credit investors want immediate stability, immediate yield. So if you look at the long-term performance of real estate, it's like 6%. So if I invested at 6%, I can't really pay more than 3 or 4% and still leave a margin for the equity investor. So asset-backed credit on real estate, might be a 3 or 4% dividend yielder, and of course, mortgage-backed securities and things like that oftentimes are a 3-4%.
So it does exist, yeah.
Asset-backed credit on an equity portfolio would be impossible for a publicly traded company to create because of the Investment Company Act of 1940. It limits public companies from investing more than 40% of their treasuries in securities. But theoretically, you could create it as a private fund, and private structured funds that do this, they're investing in something that appreciates, say, 12%. They could pay 6 or 7 or something. And the same is true with gold. Bitcoin has performed 3x that or more. So Bitcoin is simply the strongest capital asset. And because Bitcoin's been returning like 39% on average over the last 5.5 years, if you decided to issue a dividend, which was 1/3 of the capital appreciation rate, then there's a large margin of error. There's a big fat premium for the equity investors. And yet the credit is still much more compelling than any other form of credit. So the secret to STRC is we create a credit instrument that's backed by a highly liquid, high performance capital instrument. And because Bitcoin is high performance, and by the way, and the high volatility of Bitcoin creates high performance, and that creates high liquidity, and that passes through to create a high performance, high liquidity credit instrument. The credit inherits the liquidity and the performance of the capital. And, it makes logical sense that the highest powered capital will create the highest powered credit. And of course, the highest powered credit will create the highest powered money. It's like enriched uranium. You need a crypto reactor to create credit. So for every dollar of equity capital, of Bitcoin capital, you can create about 10 to 20 cents worth of digital credit. So if you have $100 billion worth of Bitcoin capital, you could create $10 to $20 billion worth of credit per year. You would need a public company. It would need to be exclusively invested in Bitcoin. So if a bank wanted to do this, they would need to create some structure that has $50 to $100 billion worth of Bitcoin held in one entity, and then they would have to go do an IPO and take a digital credit product public. If they were to do that, we would welcome that, because that would mean that another big company is buying $100 billion of Bitcoin, and I think that would be good for everybody in the Bitcoin space. If that were to happen, our Bitcoin price would go through the roof. We would end up inheriting another $50 or $100 billion worth of Bitcoin on our balance sheet in short order. Right?
Yeah.
So it's not a bad thing if they copy us. It's just unlikely that they will, because if you're a bank, your choice would be, I can invest $100 billion and create my own digital credit instrument like STRC, or I can offer digital money accounts to all of my customers to pay 8%, and I can power it with STRC, and I can keep 200 or 300 basis points of the money. So I could collect $100 billion or $1 trillion of other people's money. I could make $3 to $30 billion a year with no risk.
Right. Yeah, that makes sense.
And I could do it by partnering with Strategy and buying STRC, and I could do that starting tomorrow.
Right.
Or I can create my own crypto reactor, and I create my own. And I think, to be clear, there will be more digital credit. SATA is a very successful digital credit instrument offered by Strive. It's not as big as us. It won't have the same amount of liquidity, right? So we will simply provide the most liquid, most well-known digital credit. And if 10 other companies create other digital credit instruments, that's probably good for the ecosystem. And there are some people that will always want to diversify. They'll want 2 or 3. And there are traders that will want to trade in and out. They'll want to buy SATA, sell it, buy Stretch, sell it, etc. So I think it's good to do it. I just think that the real key here is, if you want to create the ideal credit instrument, you would like to sell $10 billion of it, and that means you need to back it with $50 billion of equity capital. And then, if people like it, you might get to $1 billion of liquidity, right? So you're trying to get to $1 billion of liquidity a day, 10, 20, 30 billion of AUM, backed by 100, 200 billion dollars worth of equity. It's a scale business, and we happen to be fortunate enough to have entered the business early and inadvertently created the scale, which now is a big competitive advantage for us.
We're going to talk about Bitcoin, and we're going to be discussing looking at the market with bear goggles on. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. one of the things that can be difficult in a market is when the market goes against you in the short term. And it's even more difficult because it's sometimes hard to know if it is just a short-term move or if it's the real deal. Last year, I said that Bitcoin was entering a bear market. This was about 5 or 6 months ago. And one of the things that I mentioned was that it made sense to just keep the bear goggles on, at least for, the first half of 2026. But obviously, I've mentioned October many, many times. And so one of the things I try to do when we are in rallies like the one we're in right now is to ask myself, is what is happening right now, is it that different from what we've previously seen in other bear markets, or are there differences? And if I can find differences, then maybe I should take the bear goggles off. Or if it still looks the same, then you could still justify why having the bear goggles on has made sense for the last several months. Now, let's talk a little bit about the bear market rallies. One of the things that I said going into the bear market, this was back in, late last year, is I said I wasn't even going to try to time any of the counter trend rallies, right? I wasn't even going to try to time them, but I would talk about them as to when lows in the market would likely occur. And one of the ones that I said we likely would have a low in February and then another low in April. I said it could be a higher low, but technically speaking, the low, I believe, occurred in late March. So technically speaking, that view was wrong because the low actually occurred like the last day of March or the second to last day of March rather than early April. And also it wasn't even a lower low. And, I thought there was a decent chance it could be a lower low. So it goes to show you why it's so difficult to know exactly when the counter trend rallies are going to occur. And when I try, I get it wrong, everyone just hates me for like the next 3 months. So that's essentially where we are right now. But what I want to do is talk a little bit about how bear markets have played out in the past. And, is there a reason to take the bear goggles off or is there not? Obviously, one main difference about this bear market compared to the bear markets of prior midterm years is that Bitcoin topped on apathy rather than euphoria. We had a euphoric 2013 top. We had a euphoric 2017 top. And a euphoric 2021 top. And so you could say that maybe the bear market characterized after a non-euphoric top would be different. And I would agree with that in some ways. And that's one of the reasons why we've also made the comparison to the 2019 bear market. Now, some people might say, well, why would you call it a non-euphoric top when Bitcoin still went to all-time highs? Yes, it didn't go up as much as it normally does, but we already would have expected that with diminishing returns, okay? So what I would say is this. When you look at the social interest of crypto this past cycle, it essentially remained relatively low, okay? So if you look at YouTube views to a lot of the different crypto YouTube channels, you can see that views never really came back. And it's not just YouTube, it's on Twitter as well. And if you look at followers to various analysts on Twitter, that also had pretty big spikes previously. But then this past cycle, retail never really came back. So that is the argument for why it was a more apathetic top. And then the other clear argument for a more apathetic top was there was no rotation into higher risk assets like altcoins. You can see that Bitcoin dominance has just continued to go up. And recently it's been moving up again. And again, when you exclude stablecoins, Bitcoin dominance is at almost a new cycle high. It's not quite there yet, but it is getting really close to a new cycle high. So again, altcoins never really stopped bleeding to Bitcoin despite Bitcoin finding that top in late 2025. So what I want to talk about now is, with the move by Bitcoin, is it doing anything different than what we've previously seen? Is it? In some ways, yes. In other ways, no. one of the things that you could look at would be the year-to-date ROI of Bitcoin in midterm years. So if we look at the year-to-date ROI of Bitcoin in midterm years and look at 2026, and if you compare that to the average of prior midterm years, we're clearly trending above the average, right? So on average, Bitcoin is down about 30 to 35% from the yearly open at this point in the midterm year. But right now, it's only down about 10% from the yearly open. Now, if you overlay one standard deviation onto that chart, you can see we're kind of outside of that one standard deviation band. So clearly, there's something a little bit different by it because it's continued to stay as elevated as it has. If you look at individual years, 2014, you can see we had sort of the weakness at the same time. Then there was another period of weakness going into April, and then we rallied back up to basically where we are now, but just it was a month or two from now when we achieved it. So it's not like we haven't seen Bitcoin rise back up to to 10% below the yearly open before. You can see that actually happened in 2014 as well. So in that case, it's not different. It is a function of time, but not necessarily in terms of the overall return. In 2018, Bitcoin had a low in February and then a higher low in April, and then it ended up topping out in early May. I mean, it essentially topped around this time, give or take a day or two, right? Like in 2018, you'll see some similarities. There are differences though, right? You had a low in February and then a higher low in April. You have a sort of a low in February and then a higher low in late March. And then Bitcoin basically rallied for like 5 weeks straight and then formed a lower high in early May. And you could argue potentially that's where we are right now. But one of the differences with 2026 and 2018, is that the high in March was higher than the high in May. Whereas this time, the high in March is lower than the high in May. So again, there are similarities, but there's also differences. What's similar is when Bitcoin found the top, right? It found a top in March, and then it found a top in May. And in the lows, it found a low in February, and then it found a low in April. And then it also found a low in sort of like late June, early July. In 2014, the lows were February and April, and then October. So we sort of skipped a summer low. In fact, the summer ended up forming that lower high. So that year-to-date ROI that we showed with Bitcoin in 2026 compared to 2014, you see this high right here? That was essentially the high that Bitcoin formed in June after rallying several weeks off of that lower low in April.
So here's where we are. Bitcoin is the strongest capital asset in the world. Saylor has been saying it for 5 years, and the on-chain data keeps proving him right. 39% average ARR over the last 5.5 years. He expects 30% blended over the next 20. Even if he's half right, the architecture he's building on top of that still produces yield that no bank, no bond, and no money market fund can touch. STRC is already in BlackRock's credit index. It's already the yield source for stablecoin protocols being built right now. Retail investors are using it to park money they need back in 6 months. Institutions are using it to generate carry. And the next version of this, that zero volatility, 8% Bitcoin-backed money instrument, is the thing Saylor clearly has his eyes on. The honest question you need to ask yourself right now is simple. Where does your cash sit when you're waiting for the right moment to deploy it? Money market funds are paying 4% and heading lower. Treasuries have duration risk. The stock market has 15 to 20% volatility, and your time horizon might be short. Saylor is offering a different answer. Lower volatility than equities, higher yield than anything in traditional fixed income, backed by the hardest asset on earth. You don't have to be a Bitcoin maximalist to find that interesting. You just have to understand that the highest powered capital creates the highest powered credit. And right now, Bitcoin is the highest powered capital on the planet. If you want to go deeper on this, we covered Strategy's full balance sheet mechanics and how the MSTR premium actually works in an earlier video. Link is in the description. Drop a comment below. Are you holding STRC, watching it, or still skeptical? I read every single one. Subscribe if you're not already. New video every week, and I'll see you in the next one.